Is investing like playing the lottery? No one controls the stock market, and there's no mathematical formula to predict the prices. But what if I told you there's a very simple way to become a successful investor? You don't need to read 50 finance books or work in a bank for 10 years. In fact, it's so simple that even an 11-year-old could understand it. I'm talking about dollar cost averaging. This is an investment strategy first mentioned by Benjamin Graham, the father of value investing, Warren Buffett's mentor, professor, and colleague. If you've never heard about it, you're in for a big surprise, as this could completely change the way you see investing. And if you know it and you're not using it, there's definitely something for you to learn here. If there's one thing that gets close to guaranteed results in the stock market, this is it. And I'll tell you why. Let's start with the basics. What's dollar cost averaging? Dollar cost averaging is an investment strategy where you consistently invest a fixed amount on a regular basis. It's as simple as that. To get started, you only need to answer 3 questions. What do you want to invest in? What do you want to put your money in? How much can you invest? And how frequently can you invest that amount? For example, an answer to those questions could be, I want to invest $100 every 2 weeks in the S&P 500 index fund. Then that's exactly what you'll need to do. Every 2 weeks, you'll buy as many shares of S&P 500 index fund as $100 can buy you at that time. And that's it. That's all there is to it. Sounds very underwhelming, right? Well, that's exactly the reason why no one really talks about it. It's not flashy and it doesn't promise quick money. But you know what's the difference? The difference is it works, and it's been proven to work on many different types of investments. And it's not used by everyone because it requires 2 things that are in very short supply with many investors: patience and discipline. Dollar cost averaging only works its wonders if you use it over a long period of time, counted in years, not months. You see, the way this strategy works is by investing regularly a fixed amount, you increase by a lot your chances to get a great average purchase price. It also removes the risk of buying a stock at a high price. But most importantly, dollar cost averaging takes care of the most important factor when it comes to trading: our emotions. Remember when I told you in the beginning, even an 11-year-old could understand this strategy? Let me tell you a short story about 11-year-old Warren Buffett and the important lesson he learned when he bought his first stock. At 6 years old, Buffett received from his aunt a coin changer. Basically just a small machine you could wear on your belt to sort and give coins. This is the sort of tool that a bus driver or a gas station attendant would wear to have easy access to coins. After receiving this gift from his aunt, young Buffett wanted to find a good use for it, so he started going around his neighborhood knocking on people's door and selling them individual packs of gum or soda pops that he bought in a pack at his grandfather's supermarket. This was the beginning of several small enterprises Warren took between the age of 6 and 10. In 1941, at 11, Warren convinced his sister to buy together their first shares of a stock in the stock market. They chose Citi Service Preferred Stocks, their dad's favorite, and bought each 3 shares at a price of $38. Investing almost $120 each in the stock market at that age was incredible. Unfortunately for the young Buffetts, the stock market declined during the summer of that year, and they both lost as much as 30% of their stock value. All the while, Warren's sister kept repeating how much of a bad decision they made investing in this stock. Several months later, when the stock recovered to $40, Warren and his sister immediately sold all their shares for a measly tiny profit of $5. As they took out their money from the stock market, they had to watch the Citi Service Preferred stock rise to $202 per share. Since it took him 5 years to get the $120 that he invested in the stock market, Warren calculated that he had just lost 20 years of hard work by taking his money out of the stock market. He just lost $492 because he didn't stick with his initial plan. If only he had just kept his shares and not sold them out of fear and frustration. This is a very valuable lesson and one of the pillars to use dollar cost averaging to your advantage. It is learning the virtue of patience. Patience in the stock market completely turns around the table in your favor. If you can distinguish the great companies from the average, being patient allows you to see a market downturn as an opportunity to buy great companies at a discount. Being patient allows you to fully take advantage of compounding interest. Because as Warren Buffett's longtime partner Charlie Munger said, the first rule of compounding: never interrupt it unnecessarily. Warren Buffett's holding company, Berkshire Hathaway, is a shining example of patience in the stock market. At the end of 2022, Berkshire Hathaway owned 50 stocks, but it had been holding them for an average period of 7 years. This is one of the reasons why the company has had long-term sustained growth, averaging 19.8 compounded annual gain from 1965 to 2022, compared to a 9.9% for the S&P 500 index, beating the S&P 500 index by almost 10% every year. Berkshire Hathaway will always be a name remembered on Wall Street. Its incredible success can be linked directly to the amazing patience shown by its leaders, Warren Buffett and Charlie Munger. And seeing how rare success to this extent is, it only shows how valuable being patient and making calculated moves in the stock market really is. If you hear any kind of investing advice that promises quick and easy money, I would stay as far as possible as I can from it. Real money, real consistent returns only come to the patient investor who invests not by following his emotions, but by understanding and buying great companies geared for future success. How do you plan to apply this to your investments? Do you consider yourself a patient investor? Let me know in the comments, and don't forget to like and subscribe, and also check out my next video if you enjoyed today's topic.